As trade talks are now underway, emerging markets in China have been breaking out. The FXI, which is the biggest China ETF, and China heavy EEM, both up around 10% this year. Now, for more on this, let's bring in Brendan Ahern. He's the Chief Investment Officer at Crane Shares, who also runs his own ETFs. And one of the things, of course, we do here, Brendan, is educate people about the differences in these ETFs. So, for example, the FXI, which is the largest China ETF out there, only holds shares in Hong Kong. Those are heavily weighted towards some of the big bank shares, for example. You have an ETF that essentially exists to invest in internet names that will hold names that are not only in Hong Kong, they're on the mainland, they're here in the United States, for example, and it's a different way of looking at things. How should an investor who wants to put money in China look at these? That's what we're trying to educate people about.
Yeah, I mean, I think you have to do your ETF due diligence. That's the size of the fund, the trading volumes, the expense ratios, but also the exposures. FXI, very large ETF. 2/3 of the exposures in Chinese banks. That's a big bet on mega cap, large cap Chinese banks listed in Hong Kong. At the same time, at Crane Shares, we're very much focused on the domestic consumption story. Over the weekend, Caixin Services PMI, 53.6. So you're seeing the consumer in China is alive and well, and KWeb is really built to hold those companies that are the transmission engines for domestic consumption as it takes place online.
And yet what we saw last year, as I follow this very carefully, is there wasn't a lot of differentiation. China did not have a very good year. The S&P 500 outperformed. We were down, what, 5% on the S&P 500. But most of the China ETFs were down 20% or so here. Here's a list of them. There's a FXI, and there's the MSCI China, the KWEB, or China Internet One that you represent, that was down 30%. They were all down pretty significantly.
I mean, universally, if an ETF had China in the name or Chinese stock, it got taken out to the woodshed. But what we saw in 2017, Bob, was a very large dispersion. KWeb went up almost 70%, which is almost twice the rate of other large China ETFs.
Yeah, it comes down to whether or not you want to have technology within your portfolio. So this obviously is a dedicated ETF focused on the technology space, but also it includes companies like Alibaba and Baidu that are U.S. listed stocks, but that are obviously dependent upon Chinese economic growth. FXI does not provide that. You had MCHI, which is another iShares ETF on the list. That'll include some of those U.S. listed stocks, but be more broadly diversified across the sector landscape.
I think people need to understand, of course, that with some of these, some of the biggest Chinese companies like Alibaba, JD.com, are listed here in the United States, and they're not on some of these ETFs. That's very important to understand them. John, where does China fit into a global portfolio? You advise people on where to put money.
Yeah, I think you have to look at China. I mean, it's one of the only economies globally that's actually injecting liquidity into the system, right? So you think about what the Fed's doing, ECB, they're taking liquidity out, right? So you know, I think I mean, all of emerging markets are pretty cheap at this point. Right. China is a big part of emerging markets. You know, we tend to like MCHI a little bit more in KWEB. You kind of get the broader Chinese market. I mean, KWEB is like 30 times earnings. MCHI is more like 11, 12. MCHI, you got like, you know, double gross margins, you know, high ROE. So relative to like the risk in the portfolio, I think we would use something like MCHI.
Brendan, what about the emerging markets right now? I mean, right now, one of the problems I have with the U.S. market is it's kind of pricey. We're at 16 to 17 times forward earnings. It kind of depends on how you look at it. But the emerging markets in general is cheaper. Can you make an argument? I know you're in the emerging market business, so I don't want to put you on the spot, but can you make an argument why emerging markets should be an outperformer this year? It hasn't for a while.
It's both historic as well as relative valuations versus the U.S. market and the EM indices valuation on a historical basis. I think also if we had the Fed on pause, that could maybe tamper the dollar rally, which has been a big headwind, as well as we're starting to see commodities firm. I think what's important is, as investors in broad-based emerging markets, you have 25% of the exposure in financials, as well as an additional 15 to 20% geared to commodities. So at Crane Shares, we're very focused on capturing these domestic consumption names like we do with KWeb, and we have a fund called KEMQ that captures the EM consumer in internet and e-commerce for broad-based emerging markets.
One of the reasons that the multiple is higher is you have an internet stock.
Yes.
So the multiple is going to be a little bit higher.
Yeah. I mean, Alibaba just grew revenue 41%. As an investor, we have to pay up to capture that high rate of growth.
Yeah, and you own, of course, Alibaba, which trades here in the in the U.S. in another fund, right?
We do. We do hold Alibaba. We think it's a great company. At the same time, that China internet and e-commerce ecosystem is much more diverse, and it's something that we're seeing happen elsewhere in broad-based emerging markets. Mercado Libre in Argentina, Cielo in Brazil. This is a global phenomenon that domestic consumption is taking place online.
Okay,
Brendan, if you look at year to date, though, KWeb is up 15, MChai is up 12, so you kind of get the upside exposure with MChai, whereas last year, according to your stat, KWeb was down 30, MChai was only down 18, so you kind of capture some of those risk characteristics in MChai.
For sure, I think the heavy financial weight in MChai at over 30% kind of tethers it a little bit, provides a little bit more of the valuation. At the same time, even MChai has 29% to Alibaba and Tencent alone. So it is still a little bit of an interesting basket.
Okay.